Good day, traders and investors. My name is Roger Scott, and I'm the senior strategist of WealthPress, or for WealthPress. Today is Wednesday. It's January 26th of 2022. We're very quickly approaching the end of the first month of the year. Don't ask me where it's gone. I'm still trying to figure out where 2020 is gone. It's about 7:46. The market's going to open up in about an hour and, let's see here, about an hour and 2 hours and 15 minutes to be exact. I think I'm right. Let's see here. No, an hour and 45 minutes to be exact. Don't listen to my math at 7 in the morning before I had my coffee. So just so you know, we had consumer confidence yesterday, which is a major report because consumers impact the economy up to 2/3. Retail sales is 2/3 of the economy. And the number, consensus was 111.9. Actual number was 111.13. Number was better than expected. We had the Red Book, which is a private report for retail sales, ahead of this week's report, and the number was better than expected. Now, this is a private report of comparable chain store sales, discounters, department stores. But again, retail sales makes up a huge portion of the economy. So consumer confidence was good. Red Book was good. Today, we've got retail inventories. We've got new home sales, which I'm not too worried about. What I'm really concerned about is the Fed announcement. This is going to be big. And in light of that, let's talk about global economy, and I'll talk to you about what the Fed is going to say. Another major report is coming out tomorrow. This is GDP. This is going to tell us the growth. It would be much wiser to have the GDP before Fed speaks, but this is Wall Street. You're not going to get anything easy. And it's completely asinine to put consumer sentiment after the GDP and the FOMC. I mean, this is going to be about what a bucket of ice is worth in Alaska when it gets to like below 50, okay? I mean, this is a good report to have up here next to consumer confidence, not after all the consumer reports came out like GDP, like the Fed makes a state. I mean, don't get me started. But anyways, we also have personal income and jobless claims. Typically, jobless claims has not been that impactful because the number has been less than 200,000. But because of the Omicron variant, the numbers have been kind of a little bit spiking, and now we're expecting a higher number. So if the number goes back down to the low 200,000 or stays in the low 200,000 or stays within the average, we'll be okay. But as you can see here, the expectations are higher, but that is priced into the market. And again, on Thursday, we have the biggest report of the week, and that's going to be the GDP report, and we're expecting a consensus of 5.7% and personal expenditures of 3%. This is going to be a very important report, although I wish we had it before the Fed. In terms of volatility, it looks like the market has peaked out in terms of volatility. Unless something really drastic happens, I'm not seeing volatility go higher. And the Nasdaq is already up 1.75%, partly because Microsoft came out with numbers. They were better than expected, and the stock is up almost 4% pre-open, and I'm expecting a nice little rally from tech today. If we don't get a rally from tech, and if Microsoft fades this, we may have some trouble. Put the call ratios looking better than expected. We're moving back into positive territory, but again, we're still near the upper end of the range. So till we go back to the overbought territory, I would say that the market is still moving higher to the upside. Let's talk about global economy a little bit. It'll help us fill in the gaps. Investors are staying on the sidelines ahead of the update on inflation. That's this report today that I'm talking about right there. Stocks have gyrated. Talk about volatility. This week as markets focus on whether the U.S. central banks will clarify how fast it plans to tighten credit. The Fed's two-day meetings wraps up today at 2:30. Tension over Russia and Ukraine still there. Ukraine leaders have reassured their country that the invasion is not imminent, but Moscow denies its plan to assault, but has amassed 100,000 troops near Ukraine in recent weeks. Some on Wall Street worry that the Fed may signal plans a half-point increase in key rates. No, he's not going to do that. I really don't think he's going to do that. There's also concern that the Fed chairman, I'm going to predict the future 3 years in advance. Oh, wait. I won't. Could suggest that the central banks will raise rates more this time this year than the 4 hikes most economists are expecting. I think he's going to raise less this year than the economists are thinking. Everybody's always overshooting these things. Higher inflation has been squeezing businesses and consumers, and the Fed is expecting to combat it in 2022 by rising interest rates. Folks, if you think a quarter of a basis point rise is going to take care of our inflation, let me sell you a bridge, okay? Investors fear that the Fed could either be moving too late, or could be too aggressive, And that's what Jeff Zananeri has been saying, actually, that they're trying to catch up right now, and because of that, they're moving too late and they have to be too aggressive. But I think they're really behind the ball right now. In China, reported local COVID cases have dropped. I think we have peaked out on COVID, and people are worried that infection spreading next week's Lunar New Year holiday and the Beijing Winter Olympics will begin February 4th. I think the timing is actually pretty good. Things are getting downgraded right now in terms of the Omicron. The International Monetary Fund, the IMF, cited Omicron variant as the reason it has downgraded its forecast. So, and crude oil is baking. So, as I mentioned, volatility is declining. The number of stocks, I want to show you guys this, the number of stocks trading in the entire stock market above $2. I want to show you this number here. Look at where we're at right now. Let me get rid of this. Oh, God. Let me just clear all these studies. Still doesn't do it. There we go. So as you can see here, we've been going down to low momentum levels. And if you look, this is all the stocks out there. And if you look at this long term, let me go 10 years, you will see that we don't go below these levels very often. This is COVID right here. So this is not very typical. Now, look at the momentum levels on the Nasdaq 100. I want to show you this. This is something you really should see. We went like to 8th percentile. I mean, we went low. But look at this chart. Look at that. Look at on the Nasdaq. This is a 10-year chart. 1 time, 2 times, 3 times. If you want to call that 4 times. Let me just break it a little lower. There we go. 3 times. Let me go a little further. Let me go max. This time, COVID, 1 time before. 1, 2, 3, 4, 5, 6, 7 times in 12 years. In 12 years or 13 years. The bottom line is, and if you look at it on a weekly basis, you will see it's not looking all that different. This is COVID right here. So the market is grossly oversold right now. Now, let me tell you the price levels I'm looking at before I give you my top ETF and top option pick. So here's what I'm looking at. I want to see the Nasdaq break above the, let me give you some levels, 354 and 366. That's 354 and 356. That's the Nasdaq level we want to see break. On the S&P, we want to see the upside. We're almost there. Look at that. We're almost there. Almost. Look at that. We're almost to the 200. Well, we're already breaking this morning the 440.38. We already went over the night session to 441. So we already broke that. The next level on the S&P is just a hair above here, which is 442.50, say. 442.50, and I think there's a good chance we can break that. So 442.50 or 4,425. And on the Dow, let's look at the Dow here. Look at that. Dow's a little down, but again, we're already past these 2 bars, which means we're already above the first level I was going to give you, which was going to be at 346. We already went over there at night. We already went 346.75. So the next level is the 200-day moving average, and that's going to be the 35,000 level. I want to see the Dow break 45,000. If we could 35,000, or this Dow break 350, if you will. That's the DIA. So those are my levels. Let's also look at the small caps. Let's see how they're doing. They're doing crappy. The small caps, we want to see the small caps aren't there yet. Small caps are really lagging behind. We got a while to go on the small caps. All right, that's what I've got for you today. Now, before I let you go, I wanted to give you the top ETF, energy. Energy is the top ETF. And the best way to trade energy right now is with this XLE. and looks like it's making a higher high already. And if you look at the option prices, we may pull back a little bit, but I would go all the way to, let's see, January, February, March, April, May 20th, and I would go to the 65, 66 strike price. Plenty of liquidity, plenty of open interest. Here's where I would go, right here into these two. One or the other, 65 or 66 for May. January, February, March, April, May. Yeah, May 20th expiration. Implied volatility is at 35, historic. So we're not like at 80 right now, like VIX. So things are looking good. I like the XLE. Now, before I let you go, I want to give you guys something really, really important. I just dropped four brand new trades in my latest alpha rotation. With all the static in the market right now, with all this crazy noise and the volatility and the Fed, it's hard to trust where the best place to invest is. So I'll just throw a quick fact out there to ease everyone's mind, okay? This is the only strategy that I know that's been able to crush the S&P 500 by 9.5 times over the past 12 years. Crushed the S&P by 9.5 times over the last 12 years. You should definitely check it out right now. Click on the link below, learn more about it, and learn how to trade the strongest sector, which are constantly rotating in and out of favor. Follow the link. You don't want to miss out. Tomorrow, top ETF, top option pick. Now, I'm going to give you something else for today because it's Wednesday. I'm going to give you a long and a short. Let me do this here. Let me give you a long, a nice long. This is a good one right here. Coca-Cola. For those of you who say I don't give you free trades, Coca-Cola, let me show you this. I'd be buying right here, and if it breaks the 50-day moving average, I'd get out, and I'd put a exit at about the 63 level. Coca-Cola, KO. And for the short side, volatility. I would be selling volatility right now via the VIX VXX. You can buy put at the 23 level and ride it all the way to the $17 level. That's what I think of the market right now. Again, follow the link below. Check out Alpha Rotation. If you have any questions, concern, comments, feedback, send me an email, support@marketgeeks.com. Talk to you later, guys. XLE, strongest sector. I showed you the option, and I gave you two hot picks. One long and one short. Bye.